In this video, we're going to talk a little bit more about markets, but more, I guess, more of a kind of a little bit of a theoretical question. We want to talk about what's referred to as an efficient market. So the question here that we're trying to address is pricing. How are prices established, and then how do prices change? So the idea here is that if the markets are efficient, they include all the information that's available. So that has an impact on deciding whether or not to issue securities or not. You might hear a manager say, well, I don't want to issue stock because our stock price is just currently too low. Well, that is in defiance of the efficient market hypothesis that says the price can never be, in quotes, too low. The price is correctly and fairly priced based on the information that the public knows. So managers spend a lot of time thinking about the prices and future prices, and sometimes they will alter their decision making because of what they feel is the correct information. And again, in the end, we want to ask, what does research say about this whole thing? So what's the controversial issues, right? So evidence about market efficiency, they state, has been overstated. That is, there's too much information, and it seems to be dramatically emphasizing efficiency in general. Well, what we do know is that the marketplace is fairly efficient, but it's not perfect. So that's where the second statement comes in. It says that markets are more or less efficient. How efficient is a research question, right? So what does that mean for management? Well, if the market is fairly efficient, then the price management sees is the right price. But let's think about this maybe in a little bit more detail. We have make sure my drawing things on here. All stocks prices are created by a supply and demand mechanism. The demand mechanism is driven by you and I. You and I gather information, and if that information is good or bad, we make decisions, and that will cause the demand curve to shift. But lacking any new information, we have to assume that the price that you see is the fair price. But what kind of information is there? I'm just going to reflect on two different kinds. We'll talk maybe about that a little bit later. But there is public information, and this is the information that we use in describing this fair price. But there's also, and I'm just going to cut to the chase here, what we would refer to as inside or private information. Private information, since not everybody knows it, cannot be used or is not used to affect the demand curve. It creates what we might refer to as the true value. This is the number that management knows. This is the number that we know. So the idea here is that when we make decisions, we're always doing it on an incomplete database. So when we say the market is not efficient, the market does reflect the information that we have to use. But on the other hand, that's not the true value of the stock. So I think maybe you can see that there's a little bit of an issue here, right? About what's going on. So again, the answer or the question we're trying to ask is the information fair? The second part of the equation might be, if there is new information, how long does that take to affect the price? So we need to understand that there's two questions. Number one, is information in the price? I think most research shows that information is in the price. What kind of information? Only public information, not insider information. The other question is, when information comes to the public, it used to be inside information and now it's new information, right? Now you and I have it. How long does that take to get into the price? And that's really dependent on the kind of information. Some information gets into the price very quickly, but some information might take time to get there. So the way information should work, right, is that you have a little bit of time, right? This is the time before. Here's the day that this, in this case, it's a takeover. This is the day that takeover is announced. On that day, we see this huge spike, right? That's good news. And then the price stays the same for a couple days. So this is a picture of something that's relatively efficient. But here's one of the things that I don't think we talk a lot about in this class, but what's going on here where we have this increases in price before the information? I mean, it could be other information affecting it, but one of the ideas is that somebody is trading on the inside information. They're trading, and that's forcing the price to already move before the announcement even comes up. So again, even if we say the market is very efficient, in this case it reacts very quickly, there are some indications that maybe there's some leakages of information. So what kinds of, they refer to these as degrees. Weak form efficiency talks about historical data, past prices. Strong, semi-strong form talks about all public information. So that's where I started with this circle, said this is public. Inside this public is also historic, right? Strong form says all information is in the price. All right, that includes inside information. So if we think about research, and we'll talk about some of this as we go forward, this is what we kind of know. The market is fairly efficient with respect to historical data. Historical data gets into the price, it affects it correctly, and it gets in there fairly quickly. So there's not a lot of research that shows that you can make extra money by trading on historical data. Semi-strong form, using all public information, there's some very mixed results on how that actually would work. Again, some information, it is absorbed very quickly, and some information takes some time. So depending on the information, the semi-strong form may or may not be very efficient. The strong form efficiency basically has been shown that it is not efficient at all, that there are individuals that have inside information. And of course, if you have inside information, you should be able to make money from that. So that means prices don't reflect all the information that we know. So again, just to kind of review, markets are not strong form efficiency with some limited exceptions. Markets are semi-strong efficient. Typical investors shouldn't expect to earn abnormal returns trading on publicly available information, especially if we incorporate taxes and brokerage fees. Maybe in the future, something will come to pass that we can change that. But as of date, that's what we know about efficiency. So, what does this imply? If markets are semi-strong efficient, then we can make these statements and they should hold true. Publicly available information has no predictive power on market prices. The best forecast of future price is current price adjusted for trends. It's pointless to time the purchase of the sale or purchase of firm securities. And finally, investors can't expect to earn positive risk-adjusted returns. In other words, the price you see is a good price. It's a fair price. So there are two things that we can mention from this. One, markets are unbeatable. Two, prices are rational and they coincide with intrinsic value. So now, bubbles can occur in unbeatable markets that are not rational, right? So if something is going on that is just irrational, that's the only way bubbles can exist. So it's important to distinguish in context of bubbles and financial crisis, because financial crises are events that are rational. So what conclusions can we draw? Managers have private information. They can justifiably make some timing decisions because they know this inside stuff. They should not be making timing decisions, though, based on their personal beliefs about where markets are headed, right? If those beliefs are based on public information alone, right, it's not all the information. So, again, managers can make some decisions, but the only rationality for their decisions is they know things that nobody else knows. So the last topic that we want to just briefly mention is something called derivatives, right? So a derivative is a financial instrument that gets value from some other asset. And they can be very dangerous in a poorly regulated or just in an improperly used form. Okay, so they're very risky, very useful to risk management, though. So there are lots of types of these derivatives. We're going to highlight forwards, futures, and we'll talk a little bit about options. So, why do we need to learn about them? It's a huge market, right? Most large companies use them. And the misuse of derivatives can be disastrous, right? So again, they are an important tool that's used by management. So let's talk about something called a forward market. Think about this as a contract. You are either going to agree to buy something at the future at a certain price, or you're going to sell something in the future at a certain price. That is what it is. It is a contract. So when you get into this contract, you are obligated. You're obligated to comply with either buying or selling whatever the commodity is. So how can we hedge? How can we reduce risk? So here we have a company and they need to sell grain in 6 months, 100,000 bushels. So in order for them to make profit, they have to sell it for at least $4. There's another company, Midwest Brands Bread. They need to buy grain in 6 months. They need 100,000 bushels, but the most they're willing to pay is $5. So we go into an agreement, right? Amber Waves agrees to sell Midwest Bread 100,000 bushels in 6 months at $4.60. So Amber Waves is going to make more money than they really need, and Midwest Bread is going to sell or is going to buy at a price below their maximum price they want to buy at. So this is a contract. Now, a forward contract can be just between these two companies. It might not trade anywhere else. So it's kind of a personal agreement, if you will. A more structured agreement is what's called a futures contract. Now, these can be bought and sold. So now if we have a contract for 5,000 bushels, of course, Amber Waves would want to sell, right? Because they're going to, ultimately, in the end, they want to get this money for these things. They're going to sell the product. They're going to have 20 contracts, 5,000 apiece at $4.60 a bushel. So what's the difference between these? The difference between these is the contract, right? In a futures contract, it is a standardized contract. In fact, Amber Waves and Midwest Bread don't even talk to each other. It's all taken care of through what's called the Chicago Board of Options Exchange. So they just go in the middle, right? So they arrange this contract between these two parties. But let's say in 6 months, Amber Waves, again, they got this. They want to sell this wheat or whatever it's corn, right? They don't have to sell it to Midwest. They can sell it to anybody that wants to buy it at that price later on. Midwest Bread doesn't have to buy from Amber Waves. They just have a contract that says somebody is going to is going to buy it or sell it to them for $4.60 a bushel. It's the Chicago Board of Exchange finds the ultimate exchange, if you will. They find who is going to go through this contract. So there are all kinds of different types of futures, right? So we have some commodities. We're familiar with all of those, wheat, corn, milk, gold, oil. But you can also find currency futures, interest rate futures. So there's all kinds of contracts that have been created that help businesses lock in prices. Now, there is a whole other part of the futures market that is not in the game of hedging. They are in the game of speculating, right? So in this case, maybe somebody that bought this contract, right, thinks that the price is actually going to go to $5. So they buy this at $4.60 and they think it's going to go to $5. So they actually make 40 cents on the transaction because they think the price is going to go higher. So we have those businesses that are trying to reduce risk. And we also have investors who are trying to speculate against price changes. Another kind of an exchange here would be, they refer to these as swaps. And essentially, this is just an arrangement to swap different kinds of contracts. So if you have a futures contract in interest rates, you can swap those for maybe something that gets a lower interest if you're interested in borrowing. You can also switch from fixed rate kinds of instruments to floating rate payments. And a currency swap works the same way, except in that case, you're swapping between differences in currencies. And of course, it's way beyond this course, but depending on the forecasts of inflation and economic growth in other countries, that's when these people speculate in these currency swaps. So I don't want to talk too much about them, but it is a way of hedging risk and possibly making a little bit more money. Now, the last thing we want to talk about with respect to derivatives is something called options. So forward contracts or future contracts are obligations, right? If you get into one of those contracts, you are obligated to act. However, options are rights. They're not obligations. So if you buy an option, you have the right to do something in the future. A call option says, look, you have the right to buy this asset. Let's call it a stock so we can get on the right page here. You have the right to buy a stock at a certain price within a certain period. A put option, you buy a piece of paper. That piece of paper gives you the right to sell a stock at a certain price within a certain time frame. So if you think about buying stocks and investing in the stock market, calls, you think the stock price will go up, so you buy a call. Because if it goes up beyond what you have a paper for, say you have a right to buy it at $10, what if the stock price goes to 20? You have the right to buy it at 10, then you can go right to the market and sell it for $20 and make $10 profit. Likewise, a put is the opposite of buying a stock. You are selling the stock. You really don't want to sell a stock unless you think the price will go down. So that's what a put option is. So if we kind of look at this, options have prices. We refer to it as a premium. So if you buy an option, you have to pay the premium. Now, do you have to exercise the option? Do you have to follow through? No, it's a right. So for this stock, if you look at it, it says, look, we have a exercise price at $60. If the stock price goes above $30, sorry. If the stock price goes above $30, then now your option is going to start to make money. But let's say you have a bet. In this case, it's $5. You pay $5 for an opportunity for the stock to go up. But what if the stock goes down? The only thing you can lose is the premium. But what if you lost the stock, right? Or what if you owned the stock? Then as the stock price goes down, of course, you lose that value. So this provides us with an opportunity to hedge our stock. You buy the stock and you buy the option. If the stock price goes down, then you're going to lose this premium. But if the stock price goes up, you're actually going to make money. Next, if you look at a put, it's the opposite because it's going to gain value if the stock price goes down. And again, it just has to go down below what we refer to as the exercise price. So we have a little example here. And again, I'm not going to go through this. If you have the PowerPoint open, you can see the calculations down below. But this looks at a call option and a put option. It says if you buy this option, what happens if the price goes to a certain level? And you can then calculate the payoff, which is the value, and then of course you can calculate the profit that you could make. So what are the limitations of hedging? Right? It's a lot more difficult to hedge the asset if it doesn't trade, right? We need to have an active, efficient trading market for hedges to work. It's a lot more difficult if the amount and timings of cash flows isn't known, right? So the riskier the cash flows, the more difficult it is to hedge it. So do companies even need to hedge? Well, maybe they don't. They could go through life not hedging. However, that leads to uncertainty in the future. If we go back to our corn example, right? The company says they're willing to sell this stock for $4.60, and they have a contract to do that. But what if the stock price goes to $5? They have a piece of paper that says they can only sell it for $4.60. On the other hand, the other company, right, says, look, we're willing to buy it at $4.60. Again, what if the price is only $4? They would rather pay the lower price to buy it, but because they have this contract, they're locked in. But what hedging does for corporations is it provides certainty to the cash flows. And that's what businesses are really searching for. They may lose on some profits, but they won't lose because of prices going the wrong direction. So again, that's the end of our video. I think this last video was maybe a little bit deeper than we normally think about. And for small businesses, this hedging aspect is probably not important, only for larger corporations. I look forward to seeing you in the next video. Take care.